Yo, it's your boy Phyllis, and welcome back to another interesting episode on 12 of FX. And in today's episode, I have been analyzing the Amazon stock. So without further ado, let's jump right into the chart. Whenever I'm analyzing any chart, I always have a systematic approach. Whenever I'm analyzing any asset, the first thing I always do is to try establish the direction of that asset. And one of the best ways of doing that is by going to the high time frame. So anything from the daily time frame to the monthly time frame are all considered higher time frame. The reason why I always try to get my direction using the high time frame is because by going to the high time frame, it gives me the overall perspective or the overall picture of the market. And secondly, this is the time frame a lot of institutional traders such as bankers, large financial investors, I'm referring to guys that trade billions of dollars on a daily basis, this is the time frame they get their direction from. So you will only see the market in three phases. The first phase is an uptrend, so the market is making higher highs, higher lows. The second phase you see the market is in a downtrend, that is when the market is making lower lows and lower highs. And the third phase you're going to see the market is if the market is ranging or the market is consolidating. In this case, the market has making higher highs and higher lows because this was a high, a low, a high, a low, a high, a low, and a high. So it is making higher highs and higher lows. So we're in an uptrend. So we'll be able to establish direction of this market. The second step is to get the fractals of the market. Whenever you hear a trending market, always picture a 5-wave pattern, be it an uptrend or a downtrend. It unfolds in a 5-wave pattern. So in this case, this is an uptrend. We get a 5-wave pattern, which is a first wave, second, third, fourth, and fifth. And within each of the waves, you have what they call fractals. You have a 5-wave replica on the impulsive wave. That's I'm referring to the wave that moves in direction of the trend, which are wave 1, wave 3, and wave 5. This is it. And this is it. 1, 2, 3, 4, and 5. So this is a 5-wave, and it has the fractals, the 5-wave fractals within it. So with the aid of my trend channel, I will get the fractals of the first wave, and I'll use the first wave and the retracement, which is second wave, to get the third wave using Fibonacci extension tool or Fibonacci expansion tool. So I'll be going down to the lower time frame now for me to see the fractals properly. So this is the monthly time frame, and I will zoom in starting from the lower end of the market. So zoom in. So get the trend channel, and I will get the trend. So this is the beginning of the wave, and this was the retracement. Will be kept down here, and the midpoint will be at the end of the first minor wave or the first fractals. So as you can see, guys, this is the first wave, the second wave, the third wave, the fourth wave, and I think this is going to be the fifth wave, but we know. So let's see. And I'll get the fifth wave by extending 1 degree up. So put it up downwards. So I think there's the fifth wave. You can see the break and the retest down here. You can see the candlestick. You can see the candlestick here, a break and retest. So we've been able to get the fractals. I should draw this out. This is the first wave, second wave, the third wave, the fourth wave, and this is the fifth wave. And what came this was a retracement. So guys, if I should get to the drawing, and the drawing I did, this was the first wave, and the fractals was wave 1, wave 2, 3, 4, and 5. So we got the fractals of the first wave, which is 1, 2, 3, 4, and 5. And by getting this first wave, I could use my Fibonacci expansion tool. So Fibonacci expansion tool is used to get your profit target level. So you can use that to get, you use the first wave and the retracement to get the target level of the third wave. So where the third wave is going to end, that will be your Fibonacci expansion tool. And anywhere from 2 downwards is your third wave. So if I get my Fibonacci expansion tool, there's it is a 3-leg. It has a 3-leg or so. I call it 3-leg device, or it's a 3-leg tool. So this is the first leg. You click there. You go to the top of the end of the first wave, which was the 5th minor wave, and the retracement, which is the end of the second wave. You can see any path from these two. You can see 2 downwards. So from this level point 2 downwards, we had a major retracement down here. So that's the end of the third wave. So I should get my drawing tool and draw everything. This is the first wave, the second wave, the third wave, the fourth wave, and this is the 5th wave. Put this in a different color, like let me say this color. And now this is the 5th wave. So guys, our center of focus should be on this 5th wave, because at the end of this 5th wave, what comes next could either be a retracement or a reversal. So after a 5-wave pattern unfolds, what you either get is a retracement or a reversal. A reversal will lead to the break of this entire structure, so it will lead to the break of this structure downwards. A retracement is just a minor pullback of the market and the continuation. So the market pulls back to an area of discount, so an area where the market is cheap, and that's where we will make use of the Fibonacci retracement tool. I hope you're taking note of the name. You have Fibonacci expansion tool you use to get your profit target level, and your Fibonacci retracement tool is to know how much a trend has retraced. The Amazon stock, I don't count the fractals of this 5th wave to be sure that this 5th wave have completed and we're now either in a retracement or in a reversal. So if I zoom into this 5th wave, since this 5th wave is an impulsive bullish wave, what to expect a 5-wave pattern out of it. So if we go down to the lower time frame to see the fractals properly. So we're going down to the weekly time frame, and I extend it all the way to your left. So I will still make use of my trend channel as well. So with aid of my trend channel, you can see the first wave and the retracement. So you get the first end and the retracement, and you put the midline at the end of the first minor wave. So the midline at the end of the first minor wave, that will give us the third wave of the market. So usually the third wave usually end within the trend channel, but when you have a case whereby the third wave doesn't end within the trend channel, what you're going to be is that it's going to be a breakout, a fake breakout, and the retest of the trend channel. That's what we had here. So this is the first wave, the second wave, the third wave that broke the trend channel, and the retest of the trend channel, and that gives the 5th wave, the minor 5th wave of the market. And this is the first, second, third, which breaks broke the trend channel and the retest of the trend channel, and that gives the 5th wave. And to be sure to see what happened, I have to zoom into this 5th wave to see what happened there. So the 5th wave the 5th wave is a bullish impulsive wave. So what to expect the 5-wave pattern out of this 5th wave. So if I get the drawing tool, and this is first wave, second wave, third, fourth, and 5th. Put this in green color. And what came next was a change of character. The break of this structure was what we had, was what they called the change of character, which meant a change in the direction of the market. Now, at the end of the massive bullish 5-wave pattern, what comes next could either be a reversal or a retracement. A reversal will lead to the total break of the structure, so will lead to the break of this entire structure. That's what a reversal is going to be. So reversal is going to lead to the break of this whole structure. So reversal lead to the break of this whole structure. So the market is going to go downwards, and lead to the break of this structure. So meaning there's a change in the sentiment of traders in the market. So the traders has gone from bullish to bearish. That's a reversal, and when that happens, that's when you see Amazon stock has crashed. I don't think Amazon is going to crash because of how much the company is worth, so I'm going to treat this market as a retracement instead of a reversal. So a retracement, just a minor pullback and a continuation of the trend. So what we had was a bullish trend where you had a lot of guys that made profits, and at this point they have taken out their profits, so the market is going to go downwards, which is a pullback, and later on to attain a form of resistance at an area of discount. And what comes next is a continuation of the bullish move. So what's going to happen is that if I get back the drawing back, is that with the 8th of, I'm going to go up to the 3-month time frame to be sure of what we're doing. So what happens is that for an area of discount, you can use the Fibonacci retracement tool. I introduced Fibonacci expansion tool, which is used for getting your profit target level, but your Fibonacci retracement tool is used to get area of discount or area of premium. So if I get my Fibonacci retracement tool and I take in this whole uptrend into consideration from down here to this up place, any part from this 0.5 or 50% downwards is an area of discount, because if this is a retracement or a pullback, you are waiting for the price to come downwards to an area where the market is cheap, because we expect the market to give us another bullish uptrend. So before we enter the market, we have to make sure that the market is not expensive. So because when buying, you buy when the market is discount, when the market is cheap. You don't buy when something is expensive. So you can also apply that same idea into trading as well, by saying, okay, since I know this is a minor pullback, I can't buy from here because it's not at this 0.5, it's not below 0.5, or it's not below 50% level yet. I'm going to wait for the market to go below this 50% level first before taking a buy trade. That is psychology behind it. But we have to go back and count the fractal. So meaning, if this is a retracement, this is going to be an ABC pattern. In case you haven't watched my video on market structure using Elliott wave, I will recommend you guys to watch it. That will give you a very good understanding of market structure. So I'm going to go back to the monthly time frame and see. So this is a retracement, and if a retracement, to get an ABC pattern out of this retracement, so I'm to zoom into this, our area of retracement, into this 50. This is the first wave, second, third, fourth, and fifth. So at this area down here, this was what they call the change of character, because you have a lot of money resting at this level due to the buy that happened starting from here. So a lot of institutional traders, they place a buy order at this area that led to this bullish move upward where we could see down here. So let me go to the weekly time frame so it can be more clearer. So on the weekly time frame, in the psychology behind this market is that at this area down there, a lot of institutional traders place their buy order at this area down here. So what you have there, you have that stop loss placed below this area, and from their buy action that led to this upward move up here. So the stop loss from institutional traders result to what they call liquidity, or a pool of money resting at this area. So what happened was that if this is a correction, a retracement, this is an ABC correction. The A wave could either be a 5-wave pattern or a 3-wave pattern. This came down here and cleared out the liquidity resting down here. So it cleared the whole money resting below here. You can see this candlestick, how it broke down, a fake breakout, and it went upward and it retraced to this. So this is the A wave. So this is the A wave, a break, and this is the retest, the B wave. And what comes next is the C wave. And I said the C wave is always a 5-wave pattern. In case you haven't watched my previous videos, the C wave is always a 5-wave pattern. So to get a 5-wave pattern out of this C wave, I can read the candlestick properly. But we said this is the first wave, second, third, fourth, fifth. But I'm going to scale down to the daily time frame to see the candlestick properly. So you can see this is the first wave, a retracement. Get my drawing too. The first wave, a retracement, second wave, the third wave, the fourth wave, and the fifth wave. And if you're thinking of buying this, asset, you can say, okay, you know what, I don't have the time to go through all this whole trying to count the fractals down here. I'm going to buy on the break of this structure, which is still valid, but you have to think about your risk to reward ratio. How much are you risking and how much is going to be a reward, Or instead of doing that, you can say, okay, I'm going to scale down. I'm going to count the fractals within this minor fifth wave, and I will see on the break of the last high, I'm going to take a buy trade. So you can say, okay, since this is a bearish impulsive wave, what to expect a 5 wave fractals within this wave down here. If I have to zoom in, by zooming in and counting it, this is gonna be the first wave, second wave, the third wave, which cleared the liquidity resting above this area, took out the liquidity resting down here. So this is the third wave, the fourth wave, and the fifth wave. So what you can do is they can say, okay, you know what? Instead of buying at this 144.43, I'm going to refine the entry by, if the market breaks this last high, I'm going to take a buy trade, because you can see the market was making lower lows, lower high, lower low, lower highs, and lower low. So if you then see a high, instead of what's to come next should be a lower low and lower high, but instead once you get a high or a higher high that breaks through this, then that is what they call change of character. So meaning the sentiment of traders has shifted from a bearish to bullish, and that's an indication of a trend reversal. So it's a good time to step into the market and buy. But if you're still not comfortable with that entry and you want a better entry, so if you don't want 120.84 and you want a better entry, you can still count the fractals within this smaller fifth wave. So I put in a blue color. You can still count the fractals within this blue small fifth wave, and to expect a 5 wave pattern because it's still a bearish impulsive wave. So go down to lower time frame, like the 4 hours time frame, and try to see the fractals properly. Alright, I could see this was the first wave, second wave, the third wave, the fourth wave, and the fifth wave. So now you can say, okay, on the break of this structure, this last high, put it in a different color, in purple or so. So on the break of this structure, I'll take a buy trade. Already you could see that the market had broken this structure. But what's essentially happened down there is that this is a liquidity grab. We're already in an uptrend because this structure has already been broken already. We're in an uptrend, but it's not a good time. It's a good time to hop on the market and take a buy trade. You can, if you have enough cash in your account, but you can also get a good entry by understanding the psychology behind what's happening down there. At this area down here, you have a lot of money resting above this area due to institutional traders that took a sell trade, one, and also breakout traders that see this as an area of resistance, and on the break of this structure, they will take a buy trade. So they have a buy stop already placed in this market, so with a stop loss placed around this area. So what happens is that you have a lot of money resting at that zone in the form of liquidity resting down here. Liquidity. And I told you earlier from my previous video, like that institutional traders, they always go after liquidity. They take in internal liquidity and they head towards external liquidity. So you can see that this was the 5 wave pattern. This was the first wave, second wave, the third wave, the fourth, and the fifth wave. This fifth wave was the liquidity grab. This grab out the whole money resting down here. So a lot of traders that think this is going to be on the break of this area of resistance, they'll take a buy trade. They were trapped. This triggered that trade because they had a stop loss and they had a buy stop place at this end. So that triggered that trade with that stop loss down there. And guess what happened? It went upward and then it reversed its direction and it went the opposite direction. You can imagine how much a lot of money was lost from taking this buy trade for those that put their stop loss around this area down here. So since this is a 5 wave pattern, you can say, okay, before I take a buy trade, I want to buy at an area of discount, not area of liquidity. That's when you then take your Fibonacci retracement tool and you then think, okay, you know what, I'm going to like buy at an area of discount, and I set any area from 0.5 or 50% downwards in an area of discount. Why that is happening is that the reason why you have this liquidity grab and a retracement is because before institutional traders, before they took this buy trade you see down here, they sold the market. You can see this sell down here from this big candlestick, this sell. So they have an open sell position that is running at a loss. Even if they were at profits, they have a sell position and an open buy position still running at the same time. So what happens that when they've grabbed out the liquidity at resting above this area, they'll take their profit out from taking the buy trade, and they will then manipulate the market, what they call mitigate. So they will reduce the pain. Mitigate is like reducing the pain of the loss gotten from taking this sell trade at this area. But that is, but they'll then manipulate the market towards coming downwards towards an area of discount and closing their open sell position before taking another buy trade. So if you're not comfortable with buying at this area of 120.84, you can then say, okay, then I'm going to scale down to the lower time frame, try monitor the retracement down here to see what's happened. I know it's an ABC pattern. Has the ABC pattern completed, and on completion of the ABC pattern, I will take a buy trade. So by going down to the lower time frame, let's say the 1 hour time frame, I could see that this is the A, B, C pattern. So instead of buying at this 120.84, you can say, oh, do you know what? I'm going to buy on the break of this structure, because this was the last high in the market. On the break of this structure, I'm going to take a buy trade, which is at 108.75, which is a much better risk to reward ratio than taking from there. But a take home assignment, you can still scale down by trying, observing, analyzing the fractals of this C wave, because it's a 5-wave pattern. So let's say I go down to the 30 minutes time frame. I can also reduce my entry from 108.75. Let me go down to the 30 minutes time frame and count the fractals. So this is the first wave, second wave, fourth wave, fourth, and the fifth. So instead of buying at 108.75, I can buy on the break of this last fourth wave, this structure down here, which is at 102.76, which is also a very good entry as well. So you can also get a much better entry by scaling down and also counting the fractals of this fifth wave. So let's say I go down to the lower time frame on the 15 minutes time frame and scale in. And I know this was the first wave, second wave, third, fourth, and fifth. And you can count the fractals. You can say, okay, then on the break of this structure, this was the last major high in the market, which is at 98.91. I'll take a buy trade. So I've been able to refine my entry from 102.76 to 98.91, which is a good entry with a better, much better risk to reward ratio. And that's how you do it, guys. You go down to the lower time frame to get a better entry. But one thing you must know is that the lower you get on the time frame, the higher chance of you making mistakes. So you have to be very careful. You have to be very sure of what you're analyzing and make sure you're counting the fractals properly. So what will your profit target be? I'll have to go down up to the higher time frame. Let's say I go to the weekly time frame to get my profit target. My profit target will be at this level, which is at 187.86, which is at 187.86. Why this level? I picked this level because this is an area of liquidity, because this was a major swing in the market. So you have an external liquidity, and I said the market always take out internal liquidity and it heads towards external liquidity. So what you have down there, you have all this sell stop above. You have all this sell order with a stop loss resting above here, sell order with stop loss, stop loss, stop loss, stop loss. So all these are all internal liquidity. So the market is going to go upward, take out all this internal liquidity and head towards this external liquidity. In case you don't know much about internal and external liquidity, my last video on Wema Bank analysis, I explained in details about internal and external liquidity. So I recommend you guys to watch that. So the market is going to come down. This should be your first target level, which is at 187.86, because that's an external liquidity, and that is due to the stop loss from institutional traders. At this level, you have several things that's happening at that level. At this level, you have the institutional traders. They took a sell trade at around this area that led to this massive bearish move. So guess what? That stop loss is placed above here. And secondly, you have breakout traders that see this as an area of resistance. So that's this area of resistance will induce a lot of breakout traders, and they hope that on the break of this structure, they will take a buy trade. So they have a buy stop placed around this level with their stop loss placed below. So that stop loss from retail traders and the stop loss for institutional traders also contributes to an area of liquidity. And also, you have some traders that see this as an area of resistance, and they hope that once the market gets to this level down here, that will give you a triple top pattern, which is a reversal pattern, and they hope to take a sell trade at that level. So what happens is that they also have a sell stop placed around this level with their stop loss placed above here. So the contribution of retail traders that have buy stop and sell stop, the stop loss from the buy stop and sell stop loss from retail traders, and also the stop loss from institutional traders, results to a pool of money. That's why that area is an area of liquidity. So there's a large volume of money resting above this area, and that's where the market always goes to. The market always takes out internal liquidity and it heads towards external liquidity. So in summary of my analysis, this was the first wave, second wave, third wave, the fourth wave, and the fifth wave. And by going down to the lower time frame, let's say the monthly time frame, this is the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. And we hope the market will gain a form of resistance. This is the fifth wave, and since we're treating the market as the retracement, since this fifth wave has been completed, what comes at the end of a 5-wave pattern is either a retracement or a reversal. And we said this market is going to be a retracement and not a reversal. And for a retracement, we should be thinking of buying at an area of discount where the market is below the 50% level. So around this, anywhere this down there, should be looking for buying opportunity, or should be your POI around that region. And what comes next should be you counting the fractals of the retracement. A retracement is an ABC pattern, which is a 3-wave pattern, where the A wave could either be a 5-wave pattern or a 3-wave pattern, and the B wave is always a 3-wave pattern, and the C wave is always a 5-wave pattern. So if I go down to the weekly time frame to see the fractals properly, this is the A wave, the B wave, and the C wave. And the C wave is always a 5-wave pattern. By going down to the daily time frame, I will count the fractals of the C wave. So the C wave is this: the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. And I said you can either buy at this region down here, but to get a better risk to reward ratio, you can count the fractals of the fifth wave and to expect a 5-wave pattern out of the fifth wave, where it is the first, second, third, fourth, fifth. So you can buy on the break of this structure down here, or if you're not satisfied with that, you can buy on the break of this structure, which has already broken. So since there's been a break of the structure, you can then scale down to the lower time frame, and you can try to count the fractals of the ABC corrective wave, and you buy on the break of a major of the B wave or so. Your profit target level should be at this area, which was the last major high of the market. And I said this region because this is an area of liquidity due to the influence of institutional traders having their stop loss here, and retail traders And retail traders have two groups: those that see this as an area of resistance, the breakout traders, and they hope to take a buy trade, so they have the buy stop placed around this zone with their stop loss placed below here. And for the other group of the retail traders, those that see this as an area of resistance, and they hope that once the market gets here, to be a triple top pattern, which is a reversal pattern, and that will induce a lot of retail traders to take a sell trade. So they have a sell stop placed around this region with their stop loss placed above. So the stop loss from retail traders and the stop loss for institutional traders will result to an area of liquidity, and that's where the market always does. The market always take out internal liquidity and it heads towards external liquidity. So the internal liquidity down here, you can see this trend line liquidity. You can see down there. It's going to take out all this liquidity. It's going to take out all the stop loss placed above here, and head towards this area, because you have stop loss placed from the sell order in this area. You have a lot of sell down here, sell, stop loss, sell. So it's going to go down, take out all these guys, and head towards this external liquidity, and this should be your first profit target level. And thank you guys for watching this video. If you like what you watch, don't forget to like, comment, and subscribe. See you guys on the next episode. Thank you.